Let's be real, you can't escape the AI hype. It feels like we're in the middle of this massive $7 trillion race to build out the future. And for any investor, it seems like the can't-miss opportunity of a generation. And right now, the market has one single dominant story it's telling itself. We are at the very beginning of a multi-year supercycle. The idea of exponential growth in AI spending isn't just a possibility anymore. It's pretty much a given, and it's baked right into today's sky-high stock prices.
But here's the big question we're going to dig into. What happens if that story, that powerful narrative that everyone believes, suddenly hits a wall? What if the foundation of this whole boom is actually a lot more fragile than it looks? Well, let's start peeling back the layers.
We're going to treat this like an onion, and the very first layer of risk isn't about the tech at all. Nope, it's about the one thing that makes it all possible: the money.
So picture this. You're building a massive new data center. You have to spend billions and billions of dollars today for profits that you might not see for years, maybe even a decade. That makes these projects super sensitive to interest rates. When the cost of capital, the cost of borrowing that money goes up, the entire math behind these huge long-term bets can just fall apart.
And this isn't some abstract theory, okay? It's already happening. A survey from late 2023 found that almost 40% of CFOs had already started cutting their spending plans specifically because of high interest rates. That's a direct hit to the very budgets that are supposed to be funding this whole AI revolution. And if things get really bad, like a full-blown recession, well, history gives us a crystal-clear playbook. When companies have to tighten their belts, they'll protect the mission-critical software that keeps the lights on. But those huge, expensive hardware projects, the giant capital expenditures that define the AI boom, yeah, those are the very first things to get cut. We don't even have to guess. Just look back at the 2009 recession. Forecasts from back then showed that while software spending stayed flat, spending on computing hardware was projected to absolutely collapse, down almost 15%. It just goes to show you how vulnerable a hardware-first boom really is.
Okay, so the economic picture is a little wobbly. But come on, the technology itself is so revolutionary it can power through anything, right? Well, that brings us to the second layer of risk, where this incredible technology runs smack into the laws of physics.
Let's go a layer deeper. We're moving beyond the corporate balance sheets and into the real physical world, where the story of exponential growth is facing some very, very hard limits.
Just look at this. It's wild. The most advanced chips, the literal heart of the entire AI revolution, are basically all made in just two places, and a staggering 90% come from one single company in Taiwan. This has created an unbelievable single point of failure for the entire global industry. And to be clear, if there was a major geopolitical disruption there, we're not talking about a small hiccup. The analysis we looked at calls it a potential extinction-level event that could basically paralyze the AI hardware industry for years. It's a massive risk that, frankly, many investors seem to be completely ignoring.
Then there's the other physical wall: power. The demand for electricity from data centers is on track to more than double by 2030. Our local power grids are already struggling to keep up. I mean, you can have all the fancy chips in the world, but if you can't plug them in, they're just really expensive sand. So, you might be asking, why are we spending trillions on all this hardware in the first place? It all comes down to this core belief called scaling laws. It's this simple idea that bigger is better. More compute power and more data has consistently led to better, smarter AI. That's the whole investment thesis right there. But what if we don't have to just get bigger? What if we get smarter? See, big breakthroughs in software efficiency are a real double-edged sword. On one hand, making AI cheaper could cause demand to explode, which is great. But on the other hand, if smarter software can do more with less hardware, then raw computing power becomes less of a moat. It becomes a commodity. And that is a direct threat to the whole business model of the hardware giants. And that brings us to our final layer: the demand itself. We're building all of this incredible, mind-blowing infrastructure. But are the apps being built on top of it actually creating enough value to justify all this cost? Now this number should honestly make every single investor just pause for a second. An incredible 80% of corporate AI pilot projects never even make it to full production. They fail. That's a huge amount of investment just going up in smoke on experiments that never pay off. And here's the kicker. It's often not a technology problem, it's a business problem. Companies are really struggling to prove a clear return on investment. They get stuck in this place called pilot purgatory.
And you have to believe that at some point, the CFOs are going to start asking some really tough questions.
So that's the corporate side. What about the rest of us, the consumers? Well, the picture there is just as murky. Sure, millions of us are playing around with free AI tools, but a recent survey found that 71% of Americans would not pay a single extra dollar for AI features. So, where's the business model in that?
So you have this perfect storm brewing. On one side, you've got open source software making the applications cheaper and more competitive every single day. And on the other, you've got this massive build out of data center capacity. If demand slows down just a little bit, you could get a huge glut, and that is a textbook recipe for a brutal price war that will just crush profit margins.
Phew. Okay, so we've peeled back all those layers of risk. The economic, the physical, the demand puzzle, and now we're at the core. So as an investor, what do you actually do with all of this information?
Well, the good news is you don't have to fly blind. You can actually track specific data-driven indicators. For example, if you see data center vacancy rates start to tick up, that's your early warning for oversupply. If you see those corporate IT spending surveys turn negative, you know hardware budgets are probably next on the chopping block. Think of this as your personal risk dashboard.
And you know, every risk has a flip side, right? Where there's a problem, there's often an opportunity. If power is the real bottleneck, then maybe investing in energy infrastructure is the smart move. If everyone is racing to build chip factories outside of Taiwan, well, the companies that make the semiconductor equipment are going to win no matter where those factories are built.
Look, there is no doubt that AI is a world-changing technology, but the path to a profitable future is never, ever a straight line. Right now, the market is pricing in absolute perfection. And as we've just seen, there are some pretty big cracks in that story. So the only real question left is the one you have to ask yourself. Are any of these risks actually priced into your portfolio?